Hey guys, Matthew here, president of VIP Financial Education, and this is VIP's Financial Literacy Series. That's right, we're going to be taking another look at financial terms and topics that are crucial to your success in both personal and business finances. Now, in these videos, I like to go beyond simply just defining and describing a term or a topic, and I want to actually discuss why it matters to you, what makes it matter to you personally in your financial situation. So today, let's go ahead and look at the most popular credit scoring algorithm, the FICO Score. Now, this was created by Fair Isaac Corporation, and the FICO Score is a type of credit score that most lenders use, and they use it in tandem along with additional details on a potential borrower's credit report in order to assess the individual's credit risk. And this is so that they can determine whether or not to extend you credit. You have a FICO score, presuming that you've used credit in the past, and you have one from each of the three credit bureaus. Now, those three credit bureaus, the three main credit reporting agencies include Experian, TransUnion, and Equifax. Those should sound familiar to you. And your FICO score comes along with each bureau, and it's based on information that the credit bureaus keep on file for you, which means your FICO score can actually vary from one bureau to the next, since some of the lenders or creditors that you have will only report to specific bureaus while not necessarily reporting to all of them. So what is the range for FICO? The base FICO scores range from 300 all the way up to 850. As we've stated in a previous video, the ideal FICO score is 760 and above. Now, we here at VIP say that 760 is ideal because it's the score which allows you not just to become eligible for the best debt weapons that are currently out there, but it also gives you a 20-point wiggle room, being that 740 and up will typically earn you the best terms and interest rates possible. Now, if you'd like to learn more about debt weapons, be sure to check out our video all about them. We'll include a link in the description below, so make sure you watch that. If 760 and above is considered ideal here at VIP, one of your next best questions might be, what is the credit score you absolutely don't want to find yourself falling below? According to most lenders, individuals with scores below a 620 are often going to find it very difficult to obtain financing at a decent rate, if at all. That said, the score is not the only thing that lenders are going to take into account when determining creditworthiness. In addition to a borrower's FICO score, lenders will consider details like income. They're going to look at how long the borrower has been at his or her job. They're going to look at whether or not you're W-2'd or self-employed. They're also going to be looking at the different types of credit that are being requested. It certainly is still possible to be approved for new loans with a lower FICO credit score, but you're going to see higher interest rates, obviously, worse terms, and these are obviously going to equate to you paying a lot more money towards interest costs, especially over time. So since we like to avoid interest costs, and that's one of the main topics here on our channel, we at VIP do all we can to optimize our credit scores, and you can find several really great credit scoring hacks here on our channel. So make sure you're not only subscribed, but that you're also receiving notifications every time we upload. So click that post notification bell. You just hit the bell one time, turn on your post notifications, and it'll send you an email and an alert every time that we upload. So all right, back to the topic of FICO. So how does Fair Isaac Corporation calculate your FICO scores? In general, payment history is the most critical component. This is going to make up 35% of your overall credit score. Next is accounts owed, 30%. 15% is the length of credit history that you have, while new credit comes in at 10%. That is included with inquiries, and 10% is credited towards the mixture of credit that you have. So let's go ahead and dive into each one of these briefly. Payment history refers to whether or not you're paying your accounts on time. This is one of the most obvious, probably the one that you learned growing up, just like I did. This is such a critical component. Your credit report is going to show the payments that are submitted for each line of credit or each installment loan, and it's going to indicate if the payments were received 30, 60, 90, or 120 days late. You've got to make sure that you're paying your bills on time. Every single account needs to be paid on time. If you don't pay an electric bill, or you don't pay your cable bill, or you don't pay another utility on time, usually you've got plenty of time before that will go into collections and actually hurt your credit. Whereas any account that you are currently repaying that was lent to you is going to show up on your credit after you're 30 days late. Now, I always recommend turning on your auto pay features for these accounts and every single account that you are required to repay so that you'll never be late on a payment. The next most important piece of a FICO credit score is how much you owe. And that said, having a lot of debt does not necessarily equate to having low credit scores. This is actually a ratio of money that's owed to the amount of credit that's available to you. Let's give an example. Say person A has one credit card, which has a credit limit of say $2,000 but they have a current balance of $1,000 on that account. And let's compare that to person B, who has one credit card account as well with a limit of $10,000, but they have a balance of $3,000. Though person B has more debt, 3 times the amount of debt to person A, their ratio is only 30% of their current availability, which reflects much better on their FICO scores than the person A, who's utilizing 50% of their availability. So keeping your balances low is always going to reflect very well on your FICO scores. In fact, this is one of the easiest categories to manipulate moving forward. The third component making up your FICO score is the length of credit history. This is pretty simple. The longer you have had credit history, the better your FICO scores are going to be. This is why it is important to ensure that you are very careful about opening up new credit accounts. If you do this too often, however, it's going to reflect poorly on your average length of credit history. So that said, if you have excellent scores in the other categories, having a short credit history isn't going to necessarily be the downfall of your credit FICO score, given that it's worth only 15%. But FICO scores do take into account how long the oldest account has been opened and the age of the newest account, as well as the overall age of your file. So make sure that you're careful about closing your oldest credit cards, as that can sometimes have the greatest negative impact on your FICO score. Do not close your credit unless you have another set of eyes that agrees that that's the best decision. The last two components both each make up 10% of your FICO scores. This includes new credit, which is also going to involve inquiries, which last on your credit report for 2 years. Now, new credit refers to exactly what it sounds it would, recently opened accounts. If you open up several new accounts in a short period of time, it can look to the lenders like you're in some sort of financial trouble. It's an indication of desperation. Your perceived risk increases. That's going to result in lower credit scores. Credit mixture, the other category, is an often overlooked piece to the FICO scoring model, and it's all about the variety of the accounts that you have, how many and what types. In order to obtain the highest credit scores available, you're going to need a strong mixture of retail accounts, credit cards, installment loans, like vehicle loans or mortgages being the best of all installment loans. Now, not all of these types of accounts reflect equally on your credit report. Retail accounts are the lowest and least impactful to your scores, while mortgages can often be the highest and most impactful. Not to mention that you do have typical limits when it comes to lenders as far as how many mortgages you can have. I'd love it if you commented below if you'd like us to do a more in-depth video about the actual mixture of credit that's ideal for you. Now you know what FICO is and how it's calculated. Why does it matter? Well, like I mentioned in the start of the video, most lenders utilize this model when determining your credit worthiness. So focusing on increasing and optimizing your FICO scores is going to go a tremendously long way in many situations. I've been on both sides of this equation. I screwed my credit up when I was 18 years old, 19. My freshman year of college, my credit was bad all the way through my early 20s. I finally learned about credit in 2002 and began practicing many of the techniques necessary to raise it. So by my mid-20s, my credit scores were excellent. I went ahead and purchased a property at the wrong time, short sold that property, which was a fourplex. Talked about it many times here on the channel as well. So my credit took another big hit come 2009, 2010, when I decided to negotiate with the banks. I've been on both sides of this equation, folks. It is tremendously easier to accomplish your financial goals when your credit scores look like this, a now 844 for my personal credit score, versus a 550, 600, 650, 700, which is where my credit scores dipped while I was missing mortgage payments on a rental property. Very, very important to strategize correctly so that you can keep your credit as high as possible. Say you're a newly married couple. I have a lot of those here on this channel. I speak with a lot of you. And let's say that you're looking to buy your first home. This is not uncommon for our audience. Having good FICO scores could be the difference between you being able to get that first home mortgage or having to continue renting. Or let's say that you're in your early 20s. Let's say that you're looking to get that auto loan so that you can continue to build your credit. Being aware of and working towards optimizing your FICO score is going to go a really long way for your success in the lending space of getting that vehicle. Let's not forget also that the difference of your FICO scores for each 20-point increment from a 720 on down, 740 being the best you can have, but usually you're going to get the best interest rates or near it at 720 and up. So 720, 20-point increments, 700, 680, 660, 640, 620 and below are going to all reflect different interest rates. It could be the difference between hundreds of dollars, thousands of dollars, or even tens of thousands of dollars to you over time, depending on the loan. And we, of course, would rather pay as little in interest costs as possible while we leverage debt into wealth, which is why we utilize various techniques, all which we share with you for free here on our YouTube channel. Now, this has been an episode of VIP's Financial Literacy Series, folks. Thank you so much for your time today. Please do comment below with any financial terms or topics that you'd like us to discuss in this series. Drop that thumbs up. Please share it with your friends and family who also need to know everything they can about how credit can serve them and how they can use credit to their advantage so that they too, just like you and just like us, can build wealth with credit. Until we see you on the next video, make it a great day today and take care.
Alrighty, so I realize that some of you have not gotten one of the single most popular budgeting tools available, not to mention it's free, and that is called the Cash Flow Cruncher. So what I want to do today is walk you through the process of downloading your very own copy. It comes in the form of an Excel spreadsheet, so it's very easy to use. And it's quick to navigate. So let's go ahead and walk through that process together. Go to cashflowcruncher.com, which will take you to the download page. Simply type your email address into the field to claim your free copy and go ahead and select the red button. Immediately it'll pull up the download button, which will open a new Cashflow Cruncher spreadsheet. The first page it'll open is the Cash Flow Summary tab, which is a non-editable page. It's very important to understand that this opening tab will not require you to put any information into these fields. This actually imports the data from the other tabs below. Now, if you've ever used an Excel spreadsheet, you'll navigate the spreadsheet by going to individual pages down here. And it'll start with the revenue and assets page. On this page, you'll want to itemize each individual income that you bring into the household or the business. Now, it's always been my recommendation that you create an individual cash flow cruncher for your businesses, an individual cash flow cruncher for your real estate, and an individual cash flow cruncher for your household.